Welcome, everyone. Today, we're diving deep into the fundamentals of tax planning. I want you to think of this as a university-level walkthrough. We're going to start with the core ideas and then see how they actually play out in the real world. The goal here is to give you the framework to think strategically about your own finances.
You know, this is really the big question, isn't it? It's at the heart of all smart financial management. The principles we're about to cover in this explainer, they're designed to help you answer that question for yourself so you can make smarter, more confident decisions. So let's find out.
So, here's our game plan for today. We'll kick things off with the basic theory, then we'll look at the actual tools of the trade, and from there, we'll roll up our sleeves and apply it all to a concrete example with real numbers. By the time we're done, you'll see exactly how these concepts translate into actual, tangible results.
Okay, so let's start at the very beginning. Before we can talk about strategy, we have to establish the ground rules. What do we actually mean when we say tax planning?
Here's the textbook definition, and I want you to focus on one word here, legitimate. That is the most important word on this slide. It means these are strategies that tax authorities not only recognize, but also permit. We're not talking about finding secret loopholes. We're talking about understanding and working within the legal framework that already exists.
And this slide right here, this shows the critical difference. This is the bright line in the sand. Tax avoidance, which is what we're talking about, is perfectly legal. It's about planning your affairs to pay the minimum tax the law requires. Tax evasion, on the other hand, is a crime. It's about deception, hiding income, inventing expenses. Understanding this distinction is, without a doubt, the foundation of any sound financial strategy.
All right, so now that we know the rules of the game, let's open up the toolkit. When you get right down to it, almost all tax planning boils down to one of these three core strategies.
These are the big three: shifting, transferring, and converting. You can shift income from one year to another. You could transfer it to, say, a family trust that's in a lower tax bracket. Or you can convert the type of income, maybe from regular income into capital gains, which are often taxed at a lower rate. They're all incredibly powerful, but for our example today, we're going to zero in on that very first one, shifting.
Okay, that's enough theory for now. Honestly, the best way to really get a concept is to see it in action. So let's take this idea of shifting and apply it to a specific case study. Let's get our hands dirty with some real numbers.
So, here's our scenario. We have a company that has to make a choice about a particular deduction, and the timing of that choice is going to directly affect its tax bill over a 2-year period. This is the very essence of strategic planning.
Here's the data we're working with. Take a look. In year one, the company makes a profit of $150,000 and the tax rate is 20%. But in year two, profits drop to $100,000, and look at this, the tax rate jumps up to 30%. Now, the wild card is a $10,000 deduction. They can take it in year one, or they can wait and take it in year two. The real question is, when is that deduction most valuable?
Now, before we just start plugging in numbers, a good planner always builds a model first. We need to map out the logic. Let's create a simple calculator, just conceptually, to understand exactly how this one decision creates two totally different financial outcomes.
So here is it, the central question. It seems so simple on the surface, right? But the answer depends completely on those numbers we just looked at. It's a strategic choice between two paths, and our model is going to show us exactly where each one leads.
And this slide, this lays out the logic perfectly. Think of it as a fork in the road. If we go down path 1, we take the deduction now, which lowers our profit in year 1. If we go down path 2, we leave our year 1 profit alone and use the deduction to lower our profit in year 2 instead. The tax savings from that deduction will be different because the tax rates are different.
All right, the moment of truth. We have our data, we have our logic model. Now it's time to run the numbers and see the actual, real-world financial impact of each choice. Let's see what the math tells us.
So let's walk down path 1. If we claim that deduction right away in year 1, we just subtract the $10,000 from our profit. Our taxable income immediately drops from $150,000 down to $140,000. Simple enough.
But what if we choose path 2? Well, we decide to wait. We defer the deduction. That means for year 1, our taxable profit stays at the full $150,000. Yeah, we pay a bit more tax this year, but we've kept that deduction in our back pocket for later.
Okay, now let's see the payoff for being patient. In path 2, we use that $10,000 deduction in year 2, and remember, the tax rate in year 2 is 30%. So, 30% of $10,000, that gives us a total tax savings of $3,000. Now, let's rewind and compare that to path 1. If we had taken the deduction in the first year, it would have been applied against that lower 20% tax rate. That exact same $10,000 deduction would have only saved us $2,000 in taxes.
And here you can see the two results side by side. It's the exact same $10,000 deduction, but its value, its actual power to save you money, changes based entirely on when you decide to use it.
So what's the bottom line? The crucial point is this. By making the optimal choice, by waiting and deferring the deduction to year 2, the company saves an extra $1,000. It's just a difference between the $3,000 savings and the $2,000 savings. $1,000 saved just by making one smart timing decision.
And that is the core principle in action. This is the aha moment. The deduction became far more valuable because we used it to shield income in the year with the high tax rate. We strategically shifted that deduction out of the low tax year and into the high tax year to maximize its financial punch.
So, we've gone all the way from abstract theory to a concrete calculation. What's the big idea here? What's the key lesson you can take away and apply to your own financial life?
This is it. This is the big takeaway. At its core, smart tax planning is all about managing time. The general rule of thumb is this. You want to push income into years where you think your tax rate will be lower, and you want to pull deductions into years where you think your tax rate will be higher. It's all about knowing what's coming down the road.
And that really brings us to the final question, which is for you. Think about your own finances for a second. Maybe it's a bonus you're getting, or a contribution to your retirement account, or selling some stock. How might this simple principle of strategic timing change the way you approach that decision? That right there is the power of tax planning.